I think the same thing happened in silver. I don't know that what the magic number was, whether it was 35 or 40 or some number like that. And of course, they've lost control of it. And I think everybody knows they've lost control of it. When you watch the day-to-day data of silver, you know that they can't possibly supply the demand. OG John AG here. Big shout out to the OG community. The Love on Ninja episode 4 and the recent drops has been insane. I read every single comment, no cap. I'm working on some serious upgrades to level us all up. Jump in the WhatsApp channel if you haven't. Link in the description. It's 100% free. We just vet everyone carefully to keep scammers out. Approval might take a sec. And listen clear, I will never ask you for money, never push schemes, never DM you about wallets or ops. Zero. If anyone tries that pretending to be me, block and report immediately. Stay sharp. And if you're actually enjoying the content, learning from it, and getting real value, drop a comment with OG John AG or just OG at the end. That little tag tells me the real ones are here, locked in and paying attention. It's how I know we're building something solid together. Now let me tell you why I'm recording this at midnight on January 25th, 2026. Eric Sprott, the billionaire precious metals legend who's been in this game longer than most of us have been alive, just went on record with something that genuinely made me pause and double-check the numbers. He said, and I quote, "I own every silver junior there is. They are all overlooked, not some, not a basket, every single one." And then he dropped this. At $150 silver, these stocks go up by 10 times. We need to talk about what's happening right now in the silver junior mining space because the repricing Eric Sprott is talking about. It's not some future fantasy. It's already in motion, and most investors are completely asleep at the wheel. Let me connect the dots for you because this goes way deeper than just one billionaire making a sector bet. Sprott laid out 3 massive structural shifts happening simultaneously in the precious metals market, and when you overlay them, you start to see why he's positioning so aggressively. First, he said, when gold broke through $2,000 in 2024, the banks lost control of the gold market. Those same banks that were perpetually short, the ones we've talked about for years in the COT data, the concentrated positions that resulted in settlements like JP Morgan's $920 million fine in 2020 for manipulating precious metals markets. They can no longer hold back physical demand. And now, according to Sprott, the same thing has happened in silver. Think about what that means. We're not talking about a temporary squeeze. We're talking about a fundamental break in the paper pricing mechanism that suppressed these metals for decades. The COMEX and LBMA system where you could create infinite paper claims on finite physical metal, that game is ending. And silver, with its tiny market size compared to gold, its industrial demand explosion from solar, EVs, AI data centers, 5G infrastructure, military applications, and its monetary history, silver is the ultimate bottleneck in this transition. Now, here's where it gets interesting. Sprott talked about an allocation shift that most people aren't even considering yet. He said, imagine if major institutions adopted a new model portfolio, 60-20-20. That's 60% traditional assets, but then 20% in precious metals instead of the standard 5% or less that most portfolios hold today. He said, and this is a direct quote, we wouldn't even recognize the price. It could be like $1,000 for silver. Let that sink in. $1,000 per ounce. Now, before you think that's insane, let's do the math together. If even a fraction of the hundreds of trillions in global institutional capital shifts from a 5% precious metals allocation to 20%, we're talking about a demand shock that would overwhelm the entire above-ground supply of investment-grade silver multiple times over. The Silver Institute reported global mine production around 820 million ounces in 2024, expected flat or slightly lower at about 813 million ounces in 2025. With total supply, including recycling, not keeping pace, annual investment demand has surged into the 200-300 plus million ounce range in recent years, amid persistent structural deficits for multiple consecutive years. If institutional allocations quadruple from current levels, you're adding 600-800 million ounces or more of new demand into a market that's already running chronic shortfalls. But here's what Sprott is really telling us, and this is the part that made me go back through the numbers at 3 AM. He's not just bullish on silver, the metal. He's positioned in every silver junior miner because of the leverage dynamic that most investors are completely mispricing. Right now, today, January 25th, 2026, silver is trading around $104 per ounce, well above $100, and in uncharted triple-digit territory after breaking all-time highs recently. Yet when you look at how most silver junior miners are valued, their market caps, their enterprise values, they're still being priced as if silver is $25 to $30. That's not an exaggeration. Go look at the valuations yourself. Companies with 30 million ounce deposits, proven resources in safe jurisdictions, pre-feasibility or feasibility stage projects. They're trading at enterprise values that imply silver prices from 2019 or 2020. Spat points out that a 30 million ounce deposit at $200 per ounce silver is worth $6 billion in gross metal value. Many of these companies trade for market caps under $100 million, some under $50 million. Even accounting for extraction costs, permitting timelines, and capital requirements, the disconnect is staggering. And this is where the 10x leverage comes in. Sprott said at $150 silver, these stocks go up by 10 times. That's not hype. That's how mining economics work. When the commodity price doubles or triples, the profit margins for producers don't just double, they can increase exponentially because your fixed costs stay the same. A project that's marginally economic at $25 silver becomes a cash printing machine at $100 or $150 silver. The NPV, net present value of these deposits, increases dramatically with every $10 move in the silver price. But most investors, most fund managers, they're still using old models. They're still anchored to $20, $30 silver assumptions in their discounted cash flow models. They haven't updated their thinking to a world where silver is sustainably above $100, moving toward $150 or higher. And that's the repricing Sprott is talking about. It's not that these stocks will go up because silver goes up. It's that these stocks are already mispriced based on where silver is right now. Now let me show you what's happening in the immediate market to support this thesis. The physical shortage Sprott mentioned. It's real and it's accelerating. We've seen backwardation in silver futures multiple times over the past 18 months where near-term contracts trade at a premium to longer-dated contracts. That's not normal. That's a signal of physical tightness. We've seen CONX-registered silver inventories, the metal actually available for delivery, drop to levels that represent just days of global industrial consumption in tight periods. The arbitrage between London and Shanghai pricing has widened repeatedly, indicating supply chain stress and geographic fragmentation in the physical market. China's export controls on strategic metals, which now include certain silver-containing products and related byproducts like antimony often mined alongside silver, that's not going away. The U.S. reshoring push, the tariffs on Chinese metals, the BRICS nations diversifying away from dollar reserves into commodities and gold, these are structural trends, not cyclical. Central banks bought over 1,000 tons of gold in 2023 and similar amounts in 2024 and 2025, the highest levels in decades. That money is flowing into precious metals because global trust in fiat currency and U.S. Treasury dominance is eroding. Here's the midpoint reframe I need you to consider. Everything I just laid out, the paper market break, the institutional allocation shift, the junior miner mispricing, the physical shortage, every single piece of this puzzle was already in motion before Sprott made these comments. His statements aren't creating this opportunity. They're confirming what the smart money has already been positioning for. When a billionaire with Sprott's track record, the guy who built one of the largest silver funds in the world, who's been investing in resource companies for 40 plus years, when he says, "I own every silver junior there is." That's not speculation. That's pattern recognition from someone who's seen this movie before. Go back to the 2000s silver bull market. From 2003 to 2011, silver went from around $450 to nearly $50. During that run, junior silver miners didn't go up 10x. Some went up 20x, 30x, 50x. Companies like Silver, Wheaton, now Wheat, and Precious Metals, companies that had the right assets in the right jurisdictions at the right time, they created generational wealth for early investors. And that bull market didn't have the industrial demand drivers we have today. There was no solar boom requiring 100 plus million ounces annually. There were no EVs using silver in every battery management system and charging station. There was no AI infrastructure requiring massive data centers with silver-intensive components. The setup today is fundamentally stronger than 2003-2011. Yet the positioning is fundamentally more skeptical. Retail investors got burned in 2011-2015 when silver crashed from $50 to $14. They swore off the sector. Institutional investors ignored commodities for a decade chasing tech stocks. ESG mandates made some funds reluctant to hold miners. And now in 2026, with silver above $100, With physical shortages documented, with industrial demand at record highs, with central banks buying precious metals at record pace, the junior miners are still priced for $25 silver. That's the opportunity SPAT is talking about. And it's the opportunity most investors will miss because they're waiting for confirmation, waiting for the stocks to already be up 200% before they believe the thesis. By then, the easy money is gone. Now, I have to give you the other side because this isn't a guaranteed win, and anyone who tells you it is lying to you. There are real risks and delays that could slow this repricing. Permitting timelines for new mines can take 5-10 years in some jurisdictions. Capital requirements to build a mine can run into hundreds of millions of dollars. Commodity prices are volatile, and even if the long-term trend is up, there will be violent corrections along the way. We could see 20%, 30% pullbacks in silver, and the miners would get hit even harder. Management teams matter enormously in junior miners. Some of these companies are run by promoters, not operators. Some have terrible share structures with massive dilution. Some have assets in risky jurisdictions with political instability or regulatory uncertainty. The comics and the bullion banks, even if they've lost long-term control, they still have enormous short-term firepower to slam prices through paper manipulation, especially around options expiration or during low liquidity holiday periods. We saw it in March 2020 when silver got taken down to $12 during the COVID panic. We saw it in May 2011 when silver crashed from $49 to $33 in 4 days. These moves can and will happen again, and if you're leveraged or emotionally weak-handed, you'll get shaken out right before the next leg up. And here's the big one. We could be early. Sprott's timeline might be years, not months. The repricing might take longer than any of us expect because markets can stay irrational longer than you can stay solvent. As Keynes famously said, if you go Allen on junior miners today, expecting them to 10x in 6 months, you might be sitting on dead money or even losses for a year or two before the thesis plays out. You need patience. You need position sizing that lets you survive the volatility. You need to do your own due diligence on every single company, not just buy a basket and hope. But here's what changes the calculus. Even with all those risks, Sprott is saying the banks can no longer hold back the physical demand. That's the key phrase. Not that prices can't be manipulated short-term, but that the long-term trajectory is now determined by physical reality, not paper games. And if that's true, if the COMEX and LBMA really have lost the ability to suppress prices indefinitely through fractional reserve metal banking, then every pullback is a gift. Every washout in the miners is an opportunity to accumulate quality names at valuations that make no sense. Let me give you a technical snapshot to frame where we are right now. Silver's currently consolidating after breaking out above the $100 level and hitting all-time highs around 103 plus, a resistance that was unimaginable just a couple years ago after the 2011 peak. On the weekly chart, we're seeing higher lows and higher highs, a textbook uptrend structure. RSI on the monthly time frame shows we're not in overbought territory yet like we were in 2011, suggesting there's more room to run. Volume profile shows massive support building in the $9,100 range, which means if we do pull back, that's likely where buyers will step in aggressively. The Ichimoku cloud on the daily chart shows bullish alignment with price above the cloud and the lagging span confirming uptrend strength. For the junior miners, the GDX Junior Gold Miners ETF and SIJ Silver Junior Miners ETF are both showing similar patterns, breakouts from multi-year bases, but still well below their 2011 peaks in relative terms. That's the valuation gap Sprott is exploiting. The metals have recovered or exceeded previous highs dramatically, but the equities are still lagging far behind their previous cycle peaks. That's not normal. That's a mispricing driven by sentiment, not fundamentals. So, what's the play here for someone watching this who wants exposure but doesn't want to gamble their life savings on spec stocks? First, educate yourself. Read the Eric Sprott interview in full. The sources are in the description. Understand the thesis from the primary source, not from some YouTuber, not even from me. Second, if you don't already own physical silver, that's your foundation. Sprott himself has always emphasized physical metal as the core position. The juniors are the leverage on top, not the replacement for physical. Third, if you're going to buy junior miners, size your position appropriately. This is high risk, high reward. Don't put your rent money or your retirement savings into spec stocks. Use 5 to 10% of your portfolio for aggressive plays, not 50%. Fourth, do actual due diligence on specific companies. Look at management track records. Look at the jurisdiction where the asset is located. Look at the resource size and grade. Look at the share structure and how much dilution has happened or might happen. Look at the balance sheet and cash runway. Read the technical reports, the 43101s or NI 43101 equivalent studies. Don't just buy a ticker because someone on Twitter said it's going to the moon. Fifth, have an exit strategy. If you buy a junior at 50 cents and it goes to $5, take some profit. Rebalance. Don't get greedy and ride it all the way back down. Trailing stops, position scaling, these are your friends in volatile sectors. And sixth, understand the macro backdrop. This isn't happening in a vacuum. We're in a world of $35 trillion U.S. national debt, growing by $1 trillion every 100 days or so. We're in a world of persistent inflation despite central bank tightening. We're in a world of deglobalization and geopolitical fragmentation. We're in a world where the Bretton Woods dollar system is being challenged by BRICS, by bilateral trade agreements in local currencies, by central banks diversifying reserves. Precious metals and the companies that mine them are a direct play on the debasement of fiat currency and the return to hard assets. That thesis is intact. That thesis is accelerating. Sprott's comments about the 60-20-20 portfolio allocation, that's not just random math. That's him telling you where he thinks institutional money is going to flow over the next 5-10 years. Right now, most pension funds, most sovereign wealth funds, most family offices have less than 5% in precious metals. If that just doubles to 10%, you're talking about trillions of dollars of new demand. If it goes to 20%, as he suggests, you're talking about a complete restructuring of global capital allocation. And in that scenario, silver at $1,000 isn't hyperbole. It's a mathematical outcome of supply and demand. But here's the bottom line, and this is what I want you to take away from this video. The paper market facade that allowed unlimited synthetic supply through futures and unallocated accounts, that's crumbling. The physical shortage that we've been documenting for years, through COMEX inventory drawdowns, through mint shortages, through industrial demand exceeding mine supply, that's real and accelerating. And while silver itself is set to move significantly higher, the greatest leverage, the asymmetric opportunity that Sprott is positioning for, lies in the overlooked junior miners that are still priced for a world that doesn't exist anymore. We are in the early stages of a historic repricing. Not tomorrow, not next week, but the process has begun. And when billionaires with 4-decade track records start saying they own every single name in a sector because they're all overlooked, that's not a signal to ignore. That's a signal to pay attention, do your homework, and position accordingly with capital you can afford to put at risk. 3 takeaways. 1. The banks have lost long-term control of precious metals pricing according to Sprott, which removes the primary suppression mechanism that's capped these markets for years. 2. Silver juniors are being valued at $25 and $30 silver assumptions when the metal is over $100, creating a valuation gap that could close violently to the upside as analysts and funds update their models. 3. An institutional allocation shift from 5% to even 10% precious metals would overwhelm available supply and send prices to levels most people can't even imagine right now. The unresolved question, how long does this repricing take and how violent are the pullbacks along the way? We don't know. Markets don't move in straight lines. But if Sprott is right about the structural break in the paper market, then time is on the side of those holding physical assets and the companies that produce them. Do your due diligence. Size your positions responsibly. Understand the risks. Don't invest based on hype or fear of missing out. Make decisions based on evidence, on fundamentals, on your own research and risk tolerance. This is not financial advice. This is information for you to verify and act on according to your own situation. Invest with logic, not hype.